Right now, as we look at the tape, Block Inc. is trading at exactly 58.35 USD. That is a push to the upside of 0.71 points, translating to a 1.23% gain on the day. When you see a move like this, green on the screen, but still contained within a heavily contested trading range, it is easy to dismiss it as just another day of noise in the fintech sector. However, looking at the surface level of this price action is a mistake. The reality of what is happening at 58.35 USD is far more complex than a simple percentage gain. The expectation for Block has long been that it is a hyper-growth story, temporarily derailed by interest rates, a stock that investors are waiting to snap back to its pandemic highs. That is the expectation. The reality, however, is that the company is fundamentally changing its DNA right in front of us, shifting from a growth-at-all-costs engine into a profit-generating machine, and the market is currently struggling to figure out how to price that transition. If you are holding Tesla stock or Nvidia stock, you are used to volatility based on innovation hype. But with Block, the volatility we are seeing around this $58 level is based on an identity crisis that is finally being resolved. When we analyze the intraday movement today, hitting that 1.23% increase, we are seeing a battle between the technical resistance at $60 and the institutional accumulation happening below. The volume profiles suggest that while retail investors might be fatigued, tired of waiting for the breakout, smart money is quietly building positions. This isn't about a quick flip. This is about the valuation compression that has occurred over the last 18 months. Most people checking their Schwab Intelligent portfolios or logging into their individual brokerage accounts see Block as a broken stock because it is down significantly from its all-time highs. But if you strip away the price history and look at the current enterprise value relative to their gross profit growth, the setup is arguably more attractive now than it was when the stock was trading at $200. The difference is sentiment. At $200, the sentiment was euphoria. At 58.35, the sentiment is skepticism. And in the gap between euphoria and skepticism is where the real money is usually made. We have to address the immediate context of this price movement. The broader market has been looking for signs of a soft landing, and fintech is arguably the most sensitive sector to this macroeconomic narrative. When you use investing sites or seek investment help, you are constantly told to watch the Federal Reserve. Block is effectively a leveraged bet on the American consumer and the small business owner simultaneously. The fact that it is holding firm and pushing higher today, despite mixed signals from the broader economy, tells us there is relative strength here. It is outperforming peers that are getting dragged down by credit quality concerns. If you look at how users on the Robinhood app or those utilizing SoFi investing platforms are positioning, there is a shift from selling the rip to buying the dip. That behavioral change is crucial. It indicates that the bag holder mentality is flushing out, replaced by a new base of investors who are entering at these levels with a fresh perspective, unburdened by the losses of 2021. However, let's look deeper at the recent stock movement because the daily swings are telling a story of consolidation. For the last few weeks, Block has been coiling. We see a tightening of the Bollinger Bands on the daily chart, which usually precedes a significant expansion in volatility. The market is waiting for a catalyst to decide if this ticker belongs in the $40 range or if it is ready to reclaim the 70s. The expectation is that Block needs to announce some massive new product to move the needle. The reality is that they just need to prove they can control their costs. The rule of 40, the idea that a software company's combined growth rate and profit margin should exceed 40%, has become the new religion for Jack Dorsey and his team. They are cutting the fat. They are capping the workforce. This isn't the fun, exuberant growth story of 2020. This is a disciplined, almost ruthless efficiency story. And while that might sound boring compared to the AI narratives driving Apple stock or the semiconductor sector, efficiency is exactly what Wall Street rewards in a high interest rate environment. We must consider the volume. Today's move on decent volume suggests that the sellers at this level are exhausting their supply. When you invest online, you often look for breakout patterns. Block is currently forming a base that looks strikingly similar to the accumulation phases we saw in big tech before their recent legs up. It is not guaranteed, of course, but the risk-reward ratio at 58.35 is structurally different than it was at $80. The downside protection is bolstered by the company's massive cash pile and its ability to generate free cash flow, something that was non-existent a few years ago. This is where the comparison to other platforms becomes relevant. If you look at Interactive Brokers stock trading data or Fidelity wealth management flows, there is a rotation occurring. Capital is moving out of stagnant legacy value plays and looking for growth at a reasonable price. Block, ironically, now fits that description. Let's pause for a second on the business model itself, because understanding this is critical to understanding why the stock moves the way it does. Block is not one business. It is two distinct ecosystems trying to merge into one financial super app. On one side, you have Square, the seller ecosystem. This is the hardware you see at your local coffee shop, the point-of-sale software, the payroll services. This is a mature, cash-generating beast. It is sensitive to recession risks, yes, but it is deeply embedded in the economy. Once a merchant starts using Square, they rarely leave because the switching costs are high. It's sticky. On the other side, you have Cash App. This is the consumer side. This is the growth engine. It is a peer-to-peer payment network, a banking substitute, a crypto exchange, and a stock trading platform all in one. The friction and the opportunity lies in the integration of these two. The market has been skeptical about whether these two sides actually help each other. Does a coffee shop using Square really benefit from a customer paying with Cash App? For a long time, the answer was not really. But the reality is shifting. Block is building a closed-loop payment network. If they can get consumers to pay merchants directly through Cash App, they bypass the Visa and MasterCard rails. They cut out the middleman fees. That is the holy grail of fintech. It is why they bought Afterpay. The expectation was that the Afterpay acquisition was a disaster, a massive overpayment at the top of the market, and strictly looking at the price tag, it was. But looking at the utility, it provided the connective tissue between the seller and the consumer. It allows Block to offer lending and buy now, pay later services directly at the point of sale, keeping the data and the money within their walls. If you are using Fidelity investments or perhaps managing your own Fidelity IRAs, you know that banking is all about net interest margin and fees. Block is attacking both. By encouraging direct deposits into Cash App, they are effectively becoming a bank for the underbanked. They are capturing inflows. And by offering features like Robinhood crypto trading or stock investing within Cash App, they are capturing the investment wallet share of a demographic that typically gets ignored by Goldman Sachs. The user interface is key here. It is simple, almost too simple, which is why it works. Compare it to the complexity of an interactive brokers platform, which is great for pros but intimidating for the average person. Cash App is the on-ramp for millions of people into the financial system. That value proposition is hard to quantify on a balance sheet, but it represents massive long-term latency. Now, we have to talk about the elephant in the room, Bitcoin. Block is inextricably linked to Bitcoin. This scares away a lot of conservative money. If you are strictly an index investor using Schwab Intelligent Portfolios, you might look at Block's Bitcoin holdings and see unnecessary risk. The expectation is that if Bitcoin crashes, Block crashes. While there is a correlation, the reality is nuanced. Block doesn't just hold Bitcoin, they are building the infrastructure for it. They are building hardware wallets. They are working on mining chips. They view Bitcoin not just as an asset, but as the native currency of the internet. This is a long-term bet. If they are right, they become the standard oil of the digital age. If they are wrong, they burned a lot of R&D capital. But at the current price of 58.35, the market is essentially giving them zero credit for the Bitcoin initiative. It is priced as a pure payments company. This means the Bitcoin upside is effectively